We're in a couple of submarkets that we know really, really well. We own and operate assets in those markets, like Greenville, South Carolina, for example. We got another one locked up right now. And we know there's certain things that we go after. And it's very infrequent in today's times that you'll win a deal or we'll even get close in the top of the best and final with just rent increases. If we're, even close or remotely close, we start looking at things like valet trash. Again, they're small things, but when you collectively add them up, it could be $50 to $100 a month. And that can be the difference between winning or losing a deal.
Welcome to the How to Scale Commercial Real Estate Show. Whether you are an active or passive investor, we'll teach you how to scale your real estate investing business into something big.
Andrew Schutsky is a passionate multifamily real estate investor who balances ownership in 1,100 plus units with a full-time job as a CIO of a medical device company, along with also being a family man. Andrew, welcome to the show.
Thanks so much, brother. It's a pleasure to be here.
Hey, man, pleasure's mine. There are 3 questions I ask every guest who comes on the show in 90 seconds or less. Can you tell me, where did you start? Where are you now? And how did you get there?
Yeah, absolutely. So real estate journey for me has begun back in 2007. I started, before anybody called this, house hacking. I'm using my air quotes for those who can't see the video. My first home was on the road 50 weeks a year doing the consulting thing, learned a lot. Quickly realized I wasn't utilizing my whole house. At the time, put an ad on Craigslist with my wife at the time, or I guess like my fiance at the time, found really creepy. But it was my entryway into learning what, a house is not just a place to live in, it's a source of income. And from there, I thought my journey was going to be great. I know I don't want to work for 20, 30 years. I got to start planting some seeds. So I thought I was going to do a series of single family houses, regardless of having, that great bonus or stock structure coming up year after year. You run out of money pretty quickly. About a decade later, I found short-term rentals. I still do those and I enjoy them, but same constraint. You can only, regardless, even with 1 or 2 really good W-2 based incomes or other sources of income, you can only go so fast. Fast forward to 2019, found a 60-some page thread on Bigger Pockets. You may have heard of that site before. Around multifamily, it was actually a local guy syndicating. Read his story. He was a CPA before, and it opened my mind to this whole new world of possibilities, which I can't believe it took me that long to find it. It's almost embarrassing to admit. And from there, I kind of went full tilt, 30, 40 books, digested every podcast I could listen to, nagged anybody who had listened to my questions, and joined a mastermind program, got a mentor, went all in really, and just started to dial in on honing different crafts and just crafting new skills.
That is really cool, Andrew. I love that. So you've been long multifamily since 2019.
Correct.
That's awesome. Okay. Very, very cool. Tell me, when you say on the short-term rental side, you said that was a tougher business for you to scale just because it was kind of like just a glorified version of a single family rental. Is that what I was hearing there?
Yeah, I think what lured me to it is originally we wanted a house at the beach, and we're like, okay, the only way we can make sense of this at the time, right? We had one young kid and another one on the way. My wife's like, you're absolutely insane. We can't buy a property. I'm like, what if we could make it generate cash? So that was my foray into that. And I'm like, hey, the pros and cons there are, the pros are you're dealing with happy people. They're on vacation. You're getting paid in advance. There's no such thing as an eviction in that world. But the big con is those houses became, at least in our area in the Northeast, in the Jersey side, became very, very expensive. So your down payments and your closing costs could be well over $250,000. So, unless you're fortunate to already have a running start and have, 7 figures to play with and invest, really hard to get beyond the first 2, 3, 4 properties that way, right? Within, especially in your early 30s, like we were at the time.
Right. Yeah, absolutely. Tell us, what are you guys finding in the multifamily space right now? We're recording this on July 12th, 2022. So this will probably go live sometime mid-August of this year. But tell me, what are you guys finding in the multifamily space right now that's making sense for you?
So we're in the Southeast, generally Carolinas, Georgia, and even a little bit of the Midwest now. We got one property in Louisville. And still, despite rising interest rates, despite all the chaos in the economy, there's a lot of demand still for multifamily. A lot of, institutional and private equity are looking for a stable asset, hard, tangible assets that cash flow with tax advantages. And there's still tons of demand for multifamily. With that said, things do seem to be tilting just a little bit in favor of the buyer. You're seeing, maybe not 25, 30 offers, but maybe 5. And for the first time ever, I think 30 days ago, I saw the first price adjustment downward, or guidance pricing came down. So that was kind of actually relieving. It's you don't want to see terrible things happen in the economy, but also the silver lining of that is you get a little relief, and you're not having to go. And it's not a bloodbath as much as it was, 60 days ago now.
What do you think is driving that? Is that just because projected rents are coming down? Is that just why is that happening?
Well, I think we were, in a weird time the past 2 years, seeing double-digit rent growth, and especially in the Southeast and Texas, and even the entire Sun Belt, really. And it's not sustainable, right? I mean, we know income's not keeping up with that, so you start to see CoStar and others backing down their rent projections. There's no longer 9, 10, 12% forecasted in every market. Maybe some markets selectively, sure. But you look at that's starting to stabilize and starting to tail off. And you also look at the drastic rise in interest rates, both in bridged and fixed rate debt. The cost of capital is much higher, right? So people start to get a little nervous when that happens. Therefore, us and others and a lot of other syndicators are starting to be a little bit more conservative with their exit cap projections. So that in turn is going to soften your offers a little bit.
Right. Yeah, absolutely. And that's something that, I guess, let me ask you that as a nuanced question on an exit cap projection. Are you guys underwriting refinances anywhere in your deals right now?
Never have, and probably never will, unless there's a very unique circumstance to do so.
Got it. I like that answer. Yeah. That's something that we commonly see in deals where it's like, hey, we're going to refinance, especially a couple of years ago when we felt like things were more predictable. Like, okay, we're going to refinance 3 to 5 years from now or whatever it is. That answers the question. You're just not doing it, because I was going to say, I know
it sounds like a clear-cut answer, and it is. It's just not my philosophy. It's not any of my partners' philosophy to count on that, right? I don't have a crystal ball. I mean, I love to say, interest rates are going to be 1% higher in a year, but you really don't know that. It'd be great. Yeah, that we always look at that as a scenario. What does that look like? But I never will make that our primary business case. I look at it like I'm investing 100% of my own cash to buy a property, just like if my investors are in or not. I look at it as like, I want to be as certain as I can be, right? And I know I can't predict interest rates. No one can, right? So I don't want to count on that as a variable.
Right. And that was going to be my question is how are you compensating, especially right now, for the complete unknown of where in the world are interest rates going? So that's how you count that's how you figure it out, or how you build that in. You just don't.
And I may be in the minority here, but I'm a big fan of fixed rate debt. I know it does hurt cash flow. I know there's prepayment involved in years, 1 and 2, and it may inhibit your ability to exit early. But I really like that. Maybe I'm a little bit old school, and I'm a little bit of an old soul that way. I like that stability. My investors like that stability. So whenever possible, and it doesn't completely crush the deal, I really like, especially in today's times, the fixed rate products.
While we're on this topic, tell me about this. How are you guys underwriting deals and getting them to make sense right now? Like, what's your guys' unique proposition when you guys acquire an asset?
Well, I will tell you, there's no magic bullet, and still the majority of the deals don't make a lot of sense. But the few that do, we're in a couple of submarkets that we know really, really well. We own and operate assets in those markets, like Greenville, South Carolina, for example. We got another one locked up right now, and we know there's certain things that we go after, and it's very infrequent in today's times that you'll win a deal, or we'll even get close in the top of the best and final with just rent increases. So we're looking at a bucket called other income. Those listening may be very well this bucket, but that seems to be the differentiating factor for us. If we're even close or remotely close, we start looking at things like valet trash, cable and internet packages. And again, they're small things, but when you collectively add them up, it could be $50 to $100 a month. And that can be the difference between winning or losing a deal. Again, that other income bucket has been a huge factor. Things like tax abatements and working with the township, or, especially affordable housing. There's some things at play there. So you got to really know the submarket to know if they're viable or not. And I always look, of course, as confident as we are, look to have, 1 or 2 of our property managers also verify, this makes sense. We've implemented this out. It's been proven elsewhere. So it can't just be a guess. It has to be submarket knowledge to be applied to win that deal. So
break down valet trash for me. I don't even know what that means.
Yeah, it's actually not commonly known. I learned it from another partner of ours that he implemented on dozens of properties. And it's basically, they'll come and pick up your trash at the door and bring it out for you. And it sounds simple, but it could be $20, $25 a month. But that might be the difference between winning and losing. And it's almost always received very well at properties from what we've seen. So.
And it's amazing to me what people are willing to pay for.
Correct.
So $25 a month. okay, so you're telling me I don't have to walk my trash out. And again, it depends on, I guess you're in the Southeast, so it's not even like it's, 3 feet of snow, because I guarantee my wife and I would probably be stroking the $25 a month. It's like, okay, it's zero outside. So yes, I'll pay $25, but in the Southeast, it's not like, but
it could be
willing to pay for it.
Well, especially if you look at it, like some of the workforce housing we're in, these guys work a really long day, maybe second or third shift. They're exhausted. They're like, you know what? It's just not worth the hassle. Maybe you got 2 or 3 young kids at the house. It's just one of those things like, wow, this is something that it's a small burden on you, but hey, I'm exhausted. I don't want to spend time with this. I don't enjoy walking down 3, 4 flights of stairs, waiting for the elevator. Hey, it doesn't work for everybody, but we've had a lot of success with it. So.
Right. And that is an almost expense-free, like value add. Like it's not even capital. There's no CapEx in it. It's
a lot of times you can get the maintenance crew that's already on in-house to do that.
Right. Right. I love stuff like that. Any way that you can add value to a property without incurring, more cost to do so. I mean, that just pads the bottom line right away. I mean, that's something we're seeing right now in the RV resort space, where it's like we can add dynamic pricing and online booking it costs us a little bit, but not much.
Right.
There's no infrastructure. There's no, we're not repaving drive aisles and adding sites and everything else. It's like, this is really very simple, and yet it changes the performance of a property dramatically. So
absolutely.
I love stuff like that. Tell me about the bundle, when you said bundled internet, TV, things like that.
A lot of times we'll look to, and this is, I think, probably more commonly known. This isn't such a well-kept secret, but you can go and get a larger bulk agreement with a service provider like an Xfinity or whoever happens to be in your area, and negotiate, hey, I would like to buy 100 packages at $35 a month. Tenants on their own might buy it for $70 a month. We sell it for $55 to $60. Again, 10, 20, $30 here and there adds up, right? So it just, again, it's a win-win for the tenant and for us. Like, we get a little bit of the commission there and the bulk, economies of scale, and the tenant saves some money, versus the individual packages. So.
Right. Have you seen those, which we've done it at one of our properties, where and there's another episode here on this podcast where I interview the company that actually handles this, but where the utility company, mostly the internet company, internet and TV, will pay you as the property owner for the rights to be on your property. Have you seen that?
We've underwritten deals where that was the case. We don't own any and operate right now, but yes, absolutely have seen that in the past.
Right. And so
same with even renting space on the top of the building for a cell phone tower, like that can be common, or something. Seriously. I mean, that can be a huge money making.
Sometimes the cell towers are worth more than the building.
Correct.
When you look at those leases, you don't realize. And again, we've had, I've had Mir Waldman come on the show here, who is kind of the cell tower lease guy. And we talked all about that. It was like, oh my gosh, like there's more money in the cell tower lease than there is in the sale of the building. This is madness. So that's absolutely interesting. Tell me, the last comment you made said you guys are working on tax abatements. How are you guys figuring out, when I look at a property, again, this is why I need you to correct me. When I look at a property, I go, okay, there's a multifamily property. Like, certainly there's no tax abatements. There's nothing left there. I mean, that's all been extracted long ago when this was built and brought online. Tell me why I'm wrong.
It depends on the positioning of the property. A lot of times you're absolutely right. There's not much there. And if there is anything there, usually the broker will pick up for it. And if it's an on-market property, they'll put it and they'll count on it in the underwriting, the projections. That's already factored in. But the true gems are where you work with the township. And it could be, either the building already itself as a business already qualifies for this, or maybe as you slightly reposition it, hey, it's not affordable now, it's affordable housing, or based on that distinction, you may now qualify for a new exemption or a tax abatement. So something to look into, talk with that local township. As you get to know a submarket more and more, as you start to buy more properties, you may copy and paste from one to the other and apply the same strategy. But if you're brand new to market, it's worth exploring, because that can save you hundreds of thousands of dollars over the course of your hold period. So. Right.
Yeah. So what I hear you saying is, if you could reclassify a property potentially from one to the next, there might be the township may be hard up for, like you said, workforce housing below, that's priced 70% of whatever the adjusted median income is. And cool.
Or I mean, something we've looked at too is maybe you can designate a portion of it as commercial space. Like you have a coffee store. We even looked at doing an arcade in a building, where you have a percent has to be a commercial occupied, and then you now qualify for a new exemption, or because it brings new jobs to the area. So again, some of these may be a stretch, but it's worth exploring.
Oh, for sure. Is there a consultant that you guys work with to help you kind of explore that? Or is this something just you've self-educated on?
This has been a lot of self-education between my partners and I, and a lot of them have been educating me actually. So I'm kind of the student in this scenario, just applying what we've learned.
Man, that's awesome. Thank you for taking the time to break down just some really simple ways. I mean, again, because right now, especially in the multifamily market, people are desperate to find ways to add value to these assets. Like, how do we make this make sense? And you've just given us three relatively simple, I say simple because tax abatement still confuse the heck out of me, but relatively simple ways to look at these and go, there may be another way to take this deal down and have it make sense other than just get into a bidding war.
I mean, in summary, you got to be creative these days, right? Unless you're wildly optimistic with your projections, most likely to win, you're going to have to either accept a lower return or be really creative as to come up with a higher return. So,
absolutely.
Bottom line.
Let's shift gears here and talk about your full-time job, because you currently work a full-time job as a CIO of a medical device company. What's your plans there?
Yeah. So I guess first and foremost, I really enjoy what I do. I know I'm probably in the minority of the guests you have on the show who have a kind of a countdown calendar crossing out the days to marking the time where they can do this full time. But for me, I actually got a lot of pleasure and enjoyment out of my job. I get to travel a lot to cool places. And most importantly, I have a lot of flexibility. I work from home when I'm not traveling. So I'm not having to get up at 4:55 a.m. every day. If I do, I can spend some time working on my business. So I find there's a lot of good parallels. For example, I work in the technology realm. I love bringing technology through investment portals and websites and marketing and funnels to the investing business. And I love the stuff I learned in investing around just being that critical ROI calculation, that business acumen. I love bringing that to my day job because we look at managing millions of dollars in budgets and looking at what if I put $1 in, what do I get back? So I love bringing that acumen, and I think it's what sets me apart from a lot of my peers, my competition in the day job, bringing that proprietor, business owner, entrepreneur mindset back to my day job. So they kind of work together really well.
Got it. Okay. So tell me, I guess when you look at technology inside of what you guys are doing in medical sales, what are some things that are lacking in the commercial real estate space? You're like, man, this is a really cool way I can innovate over here in commercial real estate.
There's still a lot. I mean, number one, when you look at structuring a deal and marketing a deal and just running all the intricacies and administrative parts of bringing in investors and marketing the deal, and then even the day-to-day operations and property management, there's a lot still pen and paper or email back and forth. So I look at things like automation of campaigns, connecting people through, like basically cutting out manual tasks. I think that's really awesome. Whether it's the upfront part of like winning a deal and doing DocuSign, you'd be surprised how infrequently that stuff is leveraged. Where I bring value to a team saying, hey, why aren't we using this? Or why are we spending all the time doing this? We're highly paid professionals. This is $50 a month product. We could be saving hours of time. I love just doing simple things like that, like connecting Zapier, for example, to link a Google form back to my active campaign to automatically create contacts and distribution lists. Just one simple example of what I think that's things that are often overlooked.
Right. Yeah. And those can be, it's funny. I'm always torn, maybe because I can barely use email, right? Like you and I are completely opposite ends of the spectrum. Like I suck at using things tech related. So
all good.
Lots of help, but I get torn because sometimes it's like, okay, I do this task and I can get it done really quickly just doing it. And trying to figure out how to make the tech work for me becomes more cumbersome than just getting it done. And it's like,
I think it's important on every team to have a guy or a gal that really understands how to make that less stressful for the rest of the team, right? Because without that, like you said, it's just so much easier to throw in the towel, and it can be so overwhelming to people who don't have those reps in, I've been doing this since I've been 4 or 5 years old, right? I grew up with like one of the first computers. So it was in my DNA, but I totally recognize for most people, it's not.
Right.
They don't want it to be. And that's completely fine. And actually that's a great value, driver for me that I can help bring to the team. So.
Absolutely. Absolutely. And last question here for you is, let's talk a little bit about team. How have you effectively scaled your team while working a full-time job?
Yeah. So for me, it was a little bit of trial and error in the beginning, right? Wanting to do everything, jump in and find my own deals and underwrite them myself and marketing myself. And I just found that wasn't effective. It was a quick way to burn out. So I've kind of dialed in. Let me just focus on for the next year or two, Becoming really good at one thing. Right now, that happens to be investor relations, raising capital, building decks and doing due diligence. Like I'm not going out. I'm actually stopped going to try to find my own deals. I work with partners that I trust. I've got a few deals under my belt now. I know who I trust. I know what I want out of a deal. I know what I don't want to be doing. I don't know what I'm not good at. Let me focus on what I'm good at. And then maybe a couple of years from now, I'll revisit and start to expand that repertoire. And maybe there comes a time where I'm doing this 40, 50, 60 hours a week on my own. And maybe I will still go back to the broker thing. But for now, just dialing in on what I'm good at and just continue to work that path.
Man, that's fantastic. Andrew, thank you for taking the time to come on the show today. I certainly appreciate it. I've learned a heck of a lot from you, talking about really easy ways to add income and value to properties that are maybe a little bit off the beaten path. We talked about your transition, from house hacking into short-term rentals, and then finally discovering multifamily in 2019. And you also shared with us, why you love your job. I think it's really cool that you're like, hey, man, I love what I do, and I'm going to continue doing it. And maybe someday I'll transition out. That's not the comment, like you said, that you or I probably hear very often, where it's like,
that's right.
I just kind of like what I'm doing. So if it ain't broke, don't fix it. So absolutely,
right, brother.
And then talking about the tech stack and what it means to bring technology to a deal. I think you've shared with us some really cool things today, and I certainly appreciate it. If our listeners want to get in touch with you or learn more about you, what is the best way to do that?
Best way is to go straight to our website. Everything funnels through there. Contact. We've got the podcast in there. It's investwithredline.com. The company name is Redline Equity. We've got blogs, and we've got more importantly, a free 8-part investing course. Go check it out, sign up, and follow us.
Awesome. Andrew, thank you again. Certainly appreciate it.
No problem, brother. Great talking to you.